Retailers were smashed today after JB Hi-Fi issued its first ever profit warning, foreshadowing its first ever profit decline. 5% for the current half year. It's not much, but broking analysts and investors were merciless, cutting JB's price by 15% today, and other retailers got caught in the crossfire. Harvey Norman down 7%, Billabong 5%. It looks like those two rate cuts have not helped retailers much at all. Elsewhere, banks and resources were bid up, and the All Ordinaries finished the week with a 0.5% rise. But here's an interesting fact. The Australian resources sector and the Chinese share market have each underperformed by the same amount this year. Each is down about 23% for the year, while the Australian All Ordinaries Index and the Global Index are both down 12%. I guess it's not surprising really that Australian miners did about the same as China's share market, which is in turn anticipating a Chinese economic slowdown. The other notable thing that took place this week is that the Australian 10-year bond rate hit a record low of about 3.8%. At least I think it's a record low. The RBA website has data going back to 1969, and it's the lowest since then. Normally, a low bond rate is telling us a recession is around the corner, but these are not normal times. It might be telling us that, but global money is flooding into Australian government bonds because this is the only AAA sovereign paying more than 2% interest. The US market struggled higher because a couple of manufacturing surveys, New York and Philadelphia, showed signs of life, and European and Asian markets did much the same, except China. See above. The Australian dollar didn't get back to parity, but it's close, 99.7 US cents. And that's finance.